Hello, everyone. Thank you so much for joining us today. We are more than honored to be sitting down with David Friedman. David is a well-known figure, especially in the economics field. He attended Harvard University. He has a PhD from the University of Chicago. He's written several books, including The Machinery of Freedom, and he talks on a variety of topics from law to anarcho-capitalism and libertarianism, microeconomics, and more. Thank you so much, David, for sitting down with us today.
Happy to be here. I should say the PhD from Chicago is in physics, not economics. I switched fields later.
Duly noted. So I'm going to read an excerpt from a paper you wrote in September of 1982. It's September 23rd. It's called Gold, Paper, or Is There a Better Money? And for those who are listening, I'll put a link in the show notes. You start off this paper by stating, alternative monetary systems are too often discussed in the context of current policy debates. Will gold cure inflation? Is tight money strangling the economy? Should the Fed be independent? Instead, I will ignore the particular problems of 1982 in order to evaluate the monetary alternatives that face any society. I shall try to consider separately two issues that are often confounded: what kind of money we are to have, and who is to produce it. In evaluating the alternatives, my main concern will be how well each monetary system permits people to make plans and contracts with reasonable confidence that the money they use will not change its value over time in unexpected ways. I will also discuss costs associated with different monetary systems. So, Dr. Friedman, could you elaborate on this paper, especially as it relates to today?
Sure. Well, I don't think it relates any more to today than it does to 1982. The general point is that most people assume that government is going to be, that money is going to be issued by a government. Nowadays, that's usually paper money. At various times in the past, it's been paper money backed by gold or silver, or it's been actual gold coins or silver coins. And what I want to argue is that you want to think about the incentives of the issuing body. That is to say, how is it in their interest to act? And there are at least a couple of problems with a money issued by a government, which that government can freely change, such as a fiat currency, which is what we're used to, or a fractional reserve currency if the government can control the reserve requirement. And that is that if the government expands the money supply, it gets three effects, three effects that are potentially valuable to it. One of them is it gets some extra money to spend without visible taxes. The second one is that it will have a temporary effect on things like unemployment, because if people expect prices to be stable and you start printing more money, demand for labor goes up. Workers do not insist on higher wages because they don't realize that the prices are going to go up in the future. And so the unemployment rate drops. And that's a very, very brief sketch of sort of a standard monetarist account of business cycles and such. So the government can get often temporary benefits by an unexpected inflation. And third, an unexpected inflation benefits debtors at the expense of creditors, because it means that the $1,000 I owe you is no longer worth $1,000 after another year or two. Governments are often debtors. Sometimes governments are supported by voting blocs that are debtors, sometimes by creditors. So that means the government has an incentive sometimes to inflate. And if you look at government fiat monies, they don't have a very good record. That the US hasn't done horribly by historical standards, and certainly some other countries have done much worse. And the question is, how can you do better? And the answer, I think, is to have privately issued money by competing private banks. And this sounds sort of like a radical idea, but in fact, it's the way the monetary system of Scotland was working when Adam Smith was writing in the 18th century, had been working for quite a long time. And the basic system, this is a private fractional reserve system, and it's one in which a bank issues paper money. It guarantees that it will redeem the paper money in something valuable, typically in the Scottish case in silver, on demand. It issues typically a good deal more money than it actually holds silver, but that's because it has other assets because when it issues money, it buys stuff, and there may well be investors who set up the bank in the first place. And so if lots of people decide they want their silver, the first 10,000 come in and they get silver coins. They get them by handing in paper money. The bank then uses its other assets to buy more silver coins, maybe to buy back the silver coins that they just handed over, or other ones. Those silver coins they can continue as long as the bank's assets are like greater than its liabilities. It can redeem all of it, even though the actual silver coins it has are many fewer than the paper that it's issued. Now, there were a couple of ways in which the Scottish banks backstopped this system, as it were. One of them was that it might take time to get all that additional silver was always demanded. And so the banknote sometimes had what was called the option clause, which said the bank retains the option of delaying its redemption of the money by 6 months or a year, in exchange for which we will give you some preset, an extra 5% or whatever it was of the money we owe you. And the other thing they did, because one of the risks in this system is, suppose the bank holds assets, but some of those assets turn out not to be worth anything. They make mistakes. They buy land, which then turns out to be worthless, or their treasurer runs away with a bunch of money, or something else happens. So you could imagine a situation where the bank's assets become less than its liability. And that's a worry if you have paper money and you want it to be redeemed. So what the Scottish banks typically did was that one of the banks were set up as unlimited liability partnerships. And one of the partners was an independently wealthy individual, likely in that society, a aristocratic landowner. And his assets were large enough so that even if the bank ran out of money, everybody knew that he could, at a cost to himself, replace them. So you could imagine in our modern society, the equivalent of that would be to have Bill Gates or Jeff Bezos, or maybe Microsoft itself or Apple, as one partner agreeing to unlimited liability for the bank's debts. Then the question is, what are the incentives of that bank? And the answer is that if the bank issues too much money, enough money so that either people are worried it can't redeem it, or just that the amount of money it issues is such that the price of things goes up. In particular, the price of silver goes up. It now pays to take your bill that's redeemable for an ounce of silver, since an ounce of silver is now worth more than the face value of that bill. So you bring it in to get the silver, at which point, as Adam Smith points out, the bank, having issued too much money, has to spend time and effort redeeming money, printing more paper, redeeming money, printing more paper. That gets nothing out of that. So therefore, it's in the interest of the bank to maintain the value of its money, which it does, A, by being willing to redeem, and B, by not issuing more than the market will bear. And you can do that with multiple banks. Now, it is convenient, certainly would have been convenient in the past, if the multiple banks all use the same definition for their money, so that all of them make their pound note be some amount of silver, probably less than a pound of silver in the 18th century, whatever it is. Nowadays, that's less essential. I like to say that the European countries got a common money just as it became unnecessary, because converting between currencies is arithmetic, and computers do arithmetic fast and cheap. So that I can go to Europe, put a Visa card in a machine in London, and draw British pounds out of the US dollar account. The paperwork is all handled in the background by the computers. So it's less essential that all of the money be in the same units than it used to be, but it's still convenient. So that would be what I would basically advocate. Now, if you're thinking about the ideal system, you probably don't want to use either silver or gold, because silver or gold both have the weakness that their price can be, their real price, what they can exchange for, can be changed by external circumstances. So if you have, as you had in the late 19th century, you had a fairly limited output of gold, economies were growing, more countries were going on the gold standard, and the result was that prices were going down, gold was becoming more valuable. Well, that's sort of inconvenient if you've borrowed money not expecting that, and now you have to pay back money when the money is now worth more than it was when you borrowed it. In that particular case, what ended that was not any policy change. It was the combination effect of the discovery of the South African gold fields and the discovery of the cyanide process for extracting gold from low-grade ores, with the result that gold went from being a deflationary metal to an inflationary metal. Now, I should say by our standards, it was never either very deflationary or very inflationary, that a commodity standard like gold or silver is pretty stable compared to a fiat money. But still, you could do better. And you can certainly imagine circumstances pretty easily where the exchange rate between gold or the exchange rate between silver and other things you cared about changed in a random kind of way, and that's inconvenient if you're using this money. So my preferred system, though probably one that won't happen because it's more complicated, is what's referred to as a commodity bundle. So I issue my pieces of paper and I say, I don't actually redeem individual Friedman dollars. That's too much trouble. But if you bring in 1 million Friedman dollars, I will give you half a ton of grade A steel, plus 37 bushels of wheat, plus 1.5 ounces of gold, plus a list of commodities, such that, roughly speaking, they represent a price index, such as that the average exchange value of the bundle is not likely to change very much. And that would then give you a nice stable system. But that's really a detail. The basic idea is that what you want are competing private banks. Now, I've said nothing about the new technology, about Bitcoin and Ethereum and those things, which are very interesting institutions. We can talk about them if you like, but they didn't exist when I wrote that article, and I didn't expect them to exist. I was hoping that you would get an anonymous eCash, but I was thinking of a different mechanism for an anonymous eCash. But in any case, the point I'm making is only that rather than thinking about it as an issue of how should the government run the money supply, the right way of thinking about it is there any good reason why it should be done by government? I think the answer is no, that governments are poorly qualified because they have conflicts of interest in how they run the money supply, and that what the bank wants to do is to provide a stable money with predictable value. Now, if it turns out that issuing money is profitable, that is to say, if the cost of actually running the bank is less than the interest you get on the money you've gotten by putting out your paper, then you'd expect banks to compete away that excess profit because they are all trying to get customers from each other. One way of doing that is for the money to be in the form of checking accounts, in which case you can pay interest on the checking accounts. Another way, probably less convenient, would be to have money that was defined in a way so that it gradually increased its value at some fixed schedule. There are various ways you could imagine doing that. But again, that's a somewhat fine point.
You write under the subheading, the private alternative, that the simplest private monetary system is a commodity money produced by a number of private firms. We've discussed that a little bit today. Each firm mints coins of standard weight and sells them. While such a system has the disadvantage described, that system should be less vulnerable to debasement than one in which coining of money is a government monopoly. With more than one firm, customers can shift away from one that starts producing underweight coins. Can you talk about this point, this choice that the consumer might enjoy? And
in fact, one may argue that there's historical evidence, although in that case it was competition among governments. There's a very interesting book by a economic historian called Carlo Cipolla. I don't know if he's still alive or not. I think he was at Stanford or Berkeley, somewhere around there. Don't even remember the title of it, though it's somewhere in this room. But in any case, he discusses what he calls the dollars of the Middle Ages, meaning the various currencies that were in widespread use, especially for international trade. And one interesting result he reports is that silver monies inflated. They inflated by debasement. They inflated relatively slowly by our standards. I think the doubling time was about 2 centuries on average. Gold currencies didn't. And he has an explanation I think is wrong for that. But my explanation of it is that the silver currencies were mostly local monopolies. That is to say, there would be one silver currency being used in one city or one country and another in another. The gold currencies were for international trading. And the countries that issued them knew that if they started debasing their currency, somebody would use something else. So that you had the Byzantine currency, the bizant, the Islamic currency, the dinar. These are both gold currencies. A little later, you've got some Italian city-states that are issuing currency as well. And they had a strong incentive to maintain the quality of their currency because they got reputational advantages out of the fact that the whole world knew that the bezant was, the numisma was the currency of trade, or the dinar, as the case might be. But the general argument is that if you have, we've got lots of examples of commodity monies issued by governments, and they got debased, and they get debased pretty slowly by our standards. But if you take, a silver coin that gets more and more copper into it, because there's a single issuer, whereas if you have competing issuers, I'm not going to use your silver coin if I know somebody else's silver coin maintains its value and yours doesn't. It's a fairly simple point. So no, commodity currencies are certainly workable, but a commodity currency is inconvenient in a couple of ways. For one thing, you've got to mine the commodity. That's a real deadweight cost of the system. Now, a fractional reserve system based on gold or silver, you have to mine it too, but not nearly as much, because with a fractional reserve system, if I've got a reserve ratio of 10 to 1, then I only need 1 ounce of gold to maintain 10 ounces of money. And my commodity bundle, you really don't have to have any, because there's so much of the stuff out there that that if I got to redeem my dollars, I can always go and change whatever other assets I have into gold and wheat and steel and things I've got to redeem with. And in addition, of course, the commodity money is a little bit inconvenient because you got to lug the stuff around. Now you could have 100% reserve system, which is a commodity bundle where I've got a piece of paper representing my gold coin rather than the gold coin, but that's easier to lug around, but also easier to counterfeit. The nice thing about gold, of course, the reason it was a particularly convenient money in the past is that it's pretty easy to identify. Gold is the densest of any metal that they were familiar with. I think uranium is denser, but they weren't doing stuff for uranium, fortunately for them. And so you can measure it that way by measuring its density. It's also reasonably pure. Gold is quite soft, it's malleable, so that distinguishes it from gold with silver, with copper or silver alloying, especially copper, and so forth. So gold was a pretty convenient money in the past, but nowadays I think we have institutions that make it practical to do it with a lot of other things.
Currencies debased that were based on silver is not some ancient history. In fact, in this country, we had silver in our coins up until 1965 when they were taken out. And as Eisenhower gave that speech, he said that the coins that had previously been in circulation with silver in them would not exceed in metal value the face value. And of course, that was quickly not the reality. Do you have any comments on that in particular?
Well, what actually happened, you'll actually have a story which is in a way related to that. Yeah, basically the point at which the high silver coins went out of circulation was when the price of silver got high enough so it was more profitable to melt them. But it made sense to hoard them even before that, because if my 50-cent coin has silver value of 48 cents, I know that it might well have silver value of 60 or 70 cents in a couple of years. So it's a cheap gamble. At worst, I've still got 50 cents. And there was, as I remember, a point at which the government was, for some reason, issuing a high silver 50-cent piece for some purpose or other. And none of them went into circulation. Treasury, I think, said, we'll just keep minting them until there are enough. And eventually they gave up because they were all being absorbed by sensible speculators. But my personal story, actually, which is really about the sophistication of ordinary people, is that there was a time when there were 2 different kinds of paper money circulating in the US in my lifetime. Silver certificates and what I think were called maybe Federal Reserve notes. I'm not sure what the other one, but the silver certificate was actually a claim on a fixed amount of silver. And just as with the coins, as the value of silver went up, when the value of silver was getting close to the what it was monetized at, when it was getting close to the case where you get $1 worth of silver for your dollar, people started holding the silver certificates because they were a good gamble. And I was at the time living near the University of Chicago. I was a graduate student in the edge of the sort of black ghetto that's the south side of Chicago, which University of Chicago is sort of a middle-class island in a relatively lower class area. And I had a conversation with one of my friends about this, in which I mentioned the situation, and he said, "Yeah, but So I said, "That means the silver certificates aren't going to circulate." He said, "Yeah, you know that, but ordinary people don't know that." And I went into the local little grocery store, and I was buying my groceries, and the cashier, the checkout cashier, handed back to me the $5 note I was paying with. Said, "You don't want to pay with that. That's a silver certificate." And that was really neat. So anyway, so that happened, and silver certificates, of course, vanished from the market very quickly, as you would expect.
I think, yeah, there is this underestimation, generally speaking, of people, and particularly by leadership. I think
Well, part of it is that how smart people are largely depends on whether it pays to be. That is, you can have any opinion you want on global warming or evolution, and it'll have no effect on your life. But if you believe that you know how to predict horse racing, unless you do, you will discover you don't fairly quickly. And I think that's a pretty common pattern. There's very interesting work by a professor at Yale Law School, Dan Kahan, on people's beliefs. And his argument is that when you have an issue that has become identified with group membership, and evolutionary, an obvious example, that what people believe depends much more on what group they identify with than, and he argues this is rational behavior, because after all, whether I believe in evolution has no effect on the world. On the other hand, if I'm a university professor at University of Chicago, or where I was SCU, and I say I don't believe in evolution, the people around me will think I'm nuts, and they'll lower their opinion of me. If I'm in a small town where everybody's a fundamentalist Christian, and I say I believe in evolution, people are going to think maybe they should let my son date their daughter, and might not be a good person to rent a house to, and so forth. What kind of a nut am I? So it's in your interest. And the neat thing that Kahan actually has evidence for is that it turns out that the more scientifically sophisticated people are, the more likely they are to agree with their group, whether that means believing in evolution or not believing in evolution. And the argument is that the more sophisticated you are, the better you can create arguments to persuade yourself to believe what's in your interest to believe. And I think that's a very, very common pattern. You can see it all over the place.
Just on that note, yeah, can you give us any other examples? For one, I always think through consensus in science, and we always are hearing about consensus in science, and this leads me to notions of groupthink, et cetera.
Well, the particular case, of course, that's striking now is that at the moment, if you're a Democrat, you are strongly in favor of people getting vaccinated against COVID, and you think people who don't are probably crazy people and they should be pushed into doing it. If you're a Republican, you're quite likely to be on the other side of that issue. I can't test it because we don't have a parallel universe, but my guess is that if Trump had won the election, the Republicans would have been all in favor of vaccination, and the Democrats say, well, I don't know, that's a Trump vaccine. It's probably not safe. And I think that kind of pattern is very common in lots of things, unfortunately, but not surprisingly.
Back on the issue of private money. So
yes.
Can you speak to some historical examples? What comes to mind is I've done some research on in the 19th century in this country, I believe private corporations
There was so-called wildcat banking with private banks under state regulation. And the basic problem, as I understand it, is that the state regulation often required them to have a lot of their reserves in the form of state securities. And the state securities were not always a very good investment. So you had some banks that crashed as a result of that. Now, on the other hand, even if you think about it, if you think about a government fiat money with an inflation rate, say, of 4%, which we don't regard as extraordinary, so it has fortunately been lower than that recently, in order to get the equivalent of that by banks crashing in average, you'd have to have 4% of the banks every year going bust. And I don't think it was ever anything like that high. So I think the loss to money holders due to holding money in banks that might go broke was probably small compared to the loss due to holding fiat money. But it was also less predictable. That is, it was the accident of which bank broke. But yes, no, there were certainly private banks issuing money, and there are lots of other examples. The Scottish one happens to be the one that I know most about, but it isn't all that unusual, an institution. And there's a sense in which you have private monies today in the US that, for example, the ID card for the university, which I'm still an emeritus professor at, so I will have some connection, and my ID card has money on it. And that money, I don't know what the actual formal arrangement is, but it's basically in the form of, if I want to buy food in the dining hall, I use the card to pay for it. And probably, if I wanted to buy a book in the bookstore, I could. And I presume that that's a private money put out by the university, in effect, that they issue as much as they want, and then they accept it, convert it to dollars. And there are probably other examples I'm not familiar with of other organizations that have in one form or another their own money.
That example reminds me a little bit of what we're seeing in the, and I don't want to go too far down this path, but with the kind of crypto tokens of today. Now, one issue that they run in with the crypto tokens is that you can go and exchange those tokens on an exchange for other currencies. Whereas in your example, with the university credits or money, private money, you can only use that on campus.
Yeah, I think that's right. Cryptocurrencies are a very interesting subject. There, as I didn't include that in that article because they didn't exist. And the problem, Bitcoin is not at the moment, at least, a very convenient money. As far as I can tell, there isn't a cheap and easy way of making transactions with it, small transactions. And I think that's true of Ether. I haven't really paid attention to all of the different cryptocurrencies that are out there, and some of them may have done better. Also, one of the things you would like to have with an eCash is anonymity. And Bitcoin, in some sense, is the least anonymous currency that has ever existed, because every transaction is public information to everybody who's using Bitcoin. Now, on the other hand, what's public information is the transaction between accounts, not between people. And I gather there are various mechanisms by which you can, at some effort, blur it so that it's hard for an observer to actually know who's paying whom what. But it would certainly be much more convenient if I could make a payment for you and be reasonably sure no third party could observe it. And the kind of anonymous eCash that I wrote about before Bitcoin, which was Chaumian digital cash based on ideas by a Dutch cryptographer, David Chaum, is one in which I send a piece of information to you. The result is that a dollar held by a bank now is under your control instead of my control. I don't have to know who you are. You don't have to know who I am. And the bank doesn't have to know who either of us is. I've got in my book, Future Imperfect, I discuss a low-tech way of doing it just in order to show that it's not an impossible, but Chaum's way involves much more elaborate mathematics in order to do it. And it would be nice if there were a cryptocurrency that had those features. And there have been a couple of attempts, as I understand it, doing it. And I really haven't followed that literature very carefully. A few years ago, I was at a conference on cryptocurrency, blockchain or something related to that, where they let participants create their own sessions, as it were. And so I created a session on anonymous cryptocurrency. And at the time, there were two projects doing it. There was somebody from each of those projects came to that meeting, and each of them responded that they could not make it perfectly anonymous. That is to say, now that maybe that's improved since that was several years ago, but their opinion then was that if your opponent was willing to spend unlimited resources watching what everybody was doing and figuring out who was who, they could eventually break the anonymity and figure out who you are. So it's not a subject I know very much about, but it certainly would be, I suppose the ideal cryptocurrency would be one where it was easy to make transactions, where you had a high level of privacy, and where its value was predictable in the future. And that's one of the trouble with Bitcoin, of course, that Bitcoin is fine if you don't mind gambling on it. I like to say that I gave a talk a good many years ago for PorcFest, the Free State Project's New Hampshire summer event, all they paid me for was my expenses. And that was by a large margin the most profitable talk I've ever given, because they offered to pay me my expenses in Bitcoin and I accepted. And I think given what the Bitcoin was there, I think it was roughly 1 Bitcoin. So that means that for that one talk, I got what's now something like $55,000. But that was just sort of random chance, as it were. It could have also gotten 0 if it had gone the other way. So in any case, but it doesn't make a very, if you're thinking not of speculative investments, but of a safe place to put your money, or if you're saying I need a bunch of money for transactions and I don't want to have my total value randomly go up or down by 50%, then Bitcoin is not really very good for that. I've actually got on my blog some years ago my own scheme for how you would make one with stable money. And there have been other attempts at stable coins. And again, I like thinking about these things, but I'm not really interested enough to have followed the detailed math of the different versions that are there. But my stable coin was one in which you had, I should say, the nice thing about Bitcoin, unlike Xiaomi and digital cash, is it doesn't require an issuer. That the trouble with Xiaomi and digital cash, the reason it never happened, is that you need to have a bank which is issuing the money and is sufficiently reliable so that people trust it. And to be sufficiently reliable so people have trusted it, probably has to be in some reasonably respectable country, in some place like Switzerland or the US or Israel or whatever. But the governments of all of those countries don't want anonymous digital cash or anonymous cash at all. This was anonymous e-cash, because once there is a really anonymous e-cash, now all money laundering laws become unenforceable. And that's both a good and a bad thing. That is, I should say, I've generally said that the things the institutions I want are not unambiguous goods. So if you had anonymous e-cash, whether crypto or not crypto, that means that kidnapping becomes a much easier project, because one of the real risks if you're a kidnapper is that you'll be caught collecting the money. Well, that's not a problem anymore. So there are other ways of protecting against kidnapping, but that one way gets weaker. Similarly, ransomware is easier with Bitcoins than it would be with dollars, because you can't easily trace, if people go to some trouble, at least to conceal which account it is, which account is which person, you can't easily trace it. So I've got an old piece called A World of Strong Privacy, in which I'm looking at the implications of public key encryption if you have a society where it's fully implemented, which means that anybody can have a conversation with anybody that no third party can overhear. Anybody can prove at a distance who he is if he wants to, and anybody can make payments to anybody that no third party can observe. And I describe it's on my webpage if people are curious. My webpage, you might put that up to, is daviddfriedman.com. So it's easy to remember. D is my middle initial. If I'd applied for the URL 6 months earlier, I could have gotten it without the D, but someone else beat me to it. So in any case, what I was saying is that a world of strong privacy would have attractive and unattractive features. On the whole, since I think governments in many ways do more harm than good, reducing the ability of governments to enforce their laws struck me as probably a net gain. But some of the laws they want to enforce are laws I'm in favor of enforcing, like laws against kidnapping and extortion and such. And those are going to become harder to enforce too, unfortunately. So anyway, you were talking about money. I don't know if we wanted, how far beyond money you want to go at this point.
Yeah, I want to touch a little bit on perhaps examples from the Middle Ages of certain monies that are like your private alternative. However, I do want to kind of just rant on Bitcoin. Generally speaking, this is a topic that I probably know too much about at this point. But Bitcoin, what's so enticing about Bitcoin, I think, is that the idealistic background from which it comes. We have in the Genesis block of Bitcoin a reference to the bailouts. There's only going to ever be 21 million Bitcoins that will ever be produced. And I find increasingly that people who I think understand cryptocurrency don't understand this important point. They're investing in Dogecoin, they're investing in Ether. And when I tell them to this day that there's a cap on the Bitcoin supply, that it's a deflationary currency, in some ways a commentary of the inflationary fiat currencies printed by governments, They are surprised. They don't know that Dogecoin's unlimited, an infinite amount. Although, of course, I think Elon Musk, with his increasing influence over Dogecoin, could one day completely change how that is implemented. Ethereum too. Ethereum has a unlimited supply because they want to keep the cost of the transactions on the smart contracts, on the technical side of things, technological side of things, to a minimum. And so they are trying to deal with that in certain strategies. But that leads me to wonder if you can even call Ether a cryptocurrency at that point. It's perhaps some other sort of asset or commodity. It's needed in order
But it's in a
to
sense more of a cryptocurrency than Bitcoin because you can actually program in it. That is
go
to say,
on.
the neat thing about Ether, and again, I'm not an expert in any of these stuff, but the neat thing about Ether is that the way it's set up, you in effect have a programming language such that you can build a smart contract into the Ether blockchain, as I understand it, with the result that the software will enforce your thing itself. And that's a hard problem. I should say all of this is coming because some years ago, I gave a talk in Graz, Austria, and then a talk, I think the next day in Budapest. And there were people at the Graz talk who were going to the Budapest talk, and they gave me a ride back because the two cities aren't that far apart. So I spent a couple of hours in a car with a bunch of Ether people pumping them about it. And the interesting problem with what they're doing is if I make a contract with you, how does the software find out whether I've done what I agreed to? So the simple example would be, I make a bet with you that the the Dow index on a certain date will be above a certain number. And we encode it into the Ether blockchains, I understand it, such that it's supposed to deliver me the money if I win the bet, and you the money if you win the bet. And the problem is, how does it know who's won the bet? And that means you require what they refer to as an oracle. An oracle is some mechanism by which the software discovers what's happening in the real world. And the one that they described to me is what's called a Schelling oracle. And that depends on the fact that it's much easier for a bunch of strangers to coordinate on the truth than on a lie, because you can all find out what the truth is, but you'd all invent different lies. So on that particular oracle, what they do is that when I set up our contract, we also set up a side deal, which says that at a point after the date we've bet on, anybody or the first 100 people, the first 1,000 people who want, can themselves bet on the same thing. Only at this time it's already happened, so they know the answer. And if they bet wrong, they get 50 cents. If they bet right, they get 50 cents. If they get wrong, they lose the 50 cents they put up or something. So that means you've got a whole bunch of random strangers. They could bet on anything, but in fact, they're all going to bet on the true value because that's the value that they know the others are going to bet on. And the software is going to believe who most of them bet on as being the true value. So that was sort of a clever idea. And I gather they've got other ideas I don't know about for solving the same problem, but you need to do that. So Ether is really very interesting. It's in a certain sense more sophisticated than Bitcoin, or more ambitious than Bitcoin. But the fact that Bitcoin has a fixed issue, strictly, it doesn't guarantee that it's deflationary, in the sense that it doesn't guarantee that its value will go up, because that depends on the demand as well. So you could conceivably have a Bitcoin inflation if suppose somebody else brings another cryptocurrency out that's a whole lot better than Bitcoin. Well, Bitcoin is sort of neat. I'd like to have one as a souvenir, so to speak, but it's not going to be worth very much. On the other hand, if Bitcoin continues to be the dominant cryptocurrency and more people want to use cryptocurrency, then you could imagine its value could keep going up. But it's true that you can't inflate it in the sense, again, in the other sense of inflation or deflation, namely changes in the money supply. It isn't a deflationary currency. It's a currency whose inflation rate goes to zero. So you're increasing the number, but more and more gradually, and eventually stops increasing. Probably never. I don't know if it ever stops increasing, because it may go asymptotically. I'm not sure if the last.
It decreases dramatically at the end. So it's 100.
Yes,
go ahead.
I was going to say I'm sure that the rate decreases. I'm not sure it decreases to zero. It might decrease to 1 every year, and then 1 every 2 years, and 1 every 5 years, 1 every 10 years, and so forth. I don't know how the numbers work out, but it's got a ceiling, and it can't go above that ceiling. You can gradually approach it.
You mentioned you're talking about oracles. There's projects that are working on Oracle solutions for the blockchain industry. It's very clearly a huge issue, and you highlighted clearly the problem there. I want to draw attention to an experiment or a patent that Microsoft has applied for and I believe received. And I guess this kind of dovetails with both the topics we're talking about, private money as well as cryptocurrency. So I'll just read a little bit. This is a goldsilverbitcoin.com article. The article is called Inside Microsoft's Sci-Fi Human Body Tracking Cryptocurrency. Microsoft has applied for a patent of a cryptocurrency system using body activity data. In the filing, the multinational conglomerate argued that as a part of a cryptocurrency mining process, a task can be given to a user to complete. The cryptocurrency system can give a task to your device, instructing you to complete a, quote, human body activity. Any thoughts on that?
Well, it sounds like a sort of a neat way if I could give myself an incentive to do exercises, right?
Certainly.
That is, as I'm sure you know, one of the issues in cryptocurrencies with Bitcoin, the original example, is how you make it costly to produce more of it. And that, as I understand it, the Bitcoin system, there are really two costs to mining one more Bitcoin. One of them is you've got to solve a very difficult mathematical problem with lots and lots of processing. And the other is you have to update the blockchain. So you're in effect providing a service to everybody else. And in fact, I'm not quite sure how, as you approach the maximum number of Bitcoins, aren't transactions going to get slower and slower because the blockchain is being updated less and less often? I don't know how they've taken care of that problem.
That won't be affected. However, when it comes to slow transactions, the way in which the Bitcoin developers are arguing they can solve this problem is by building layers on top of Bitcoin protocol or alongside the Bitcoin protocol. So there's the Lightning Network, and their goal is to lower the cost of Bitcoin transactions. In fact, Twitter actually, I believe, just incorporated a function where you're able to tip people in Bitcoin. And this is based on the Litecoin network. The developers on Bitcoin argue that they actually have a perhaps more programmatically secure approach to these kind of higher level computations that are done on Ethereum through modularity. So they argue they can build a layer 2, the Lightning Network. Now, then there's a debate about the centralization and decentralization of the Lightning Network. But that aside, they think that you can handle transactions off of the Bitcoin blockchain through this Lightning Network and that it won't slow the transactions down.
But in order for the transaction to actually happen on the Bitcoin blockchain, somebody's got to update the blockchain. And I thought that in the Bitcoin system, what gives you an incentive to update the blockchain is that's part of mining a Bitcoin.
Yes, so there is an issue there. So I think this will be solved perhaps by, now, at least I know the way in which other blockchains are solving this. The miners, for instance, get a cut of the transactions that are being done on those other networks. I think securing, yeah, this has always been an issue. And you know what, I'm not I haven't read up on this issue in quite a while. So the solution will be interesting. I guess that what will happen is that on a second or third layer, there is the option for the miners to ultimately get paid off based off of the transactions that are being done. But right now, the miners get paid by mining blocks, which are produced every 10 minutes. And I actually pulled up the release schedule. So,
but it won't be every 10 minutes in another 10 years.
No, it actually will remain constant. However, you'll be receiving fewer and fewer Bitcoins.
Oh, I see. I didn't realize that. Right. So but then hopefully they will be worth more and more, and therefore it'll still be worth doing.
I guess, yes, that's a good point. And I believe that would be true. This is kind of speaking back to the concept of whether or not Bitcoin is deflationary or not. You argue it isn't. I like your explanation. In fact, most Bitcoiners argue that it is. It's kind of just a given that it's deflationary. You mentioned that demand has to increase, or can it just remain constant?
If it remains constant, then Bitcoins will gradually lose value because the number increases, but they will go asymptotically to whatever the value would be when all of them are mined. So they're going to lose value, but more and more slowly. And you can only describe that as deflationary if you assume that inflation is the normal state of the world, and therefore less inflationary counts as deflationary. But if the demand for them is going up, then they could be deflationary in the price sense, but not in the stock of money sense. And different people use inflation and deflation either as a statement about how much money there is or about the price level. But in any case, Bitcoins are definitely an interesting institution. It would be sort of fun to watch them, but it's not something I do full time or anything close to full time.
Certainly. And so just to kind of go over the block reward real quick, upon launch on January 3rd, 2009, the block reward was 50. In the most recent halving of May 2020, it dropped to 6.25 Bitcoins per block reward. And in the last one, which is expected in the sixth halving, which is expected in 2032, this won't be the last halving. It is to be 0.78125 Bitcoins as the block reward. And I didn't realize, but this doesn't go all the way to, I believe Bitcoins are expected to be mined until about 2140 was the estimate. I suppose
2140?
Yeah, I suppose that could change depending on technological advancements, et cetera. Back to the private money. So can you kind of give examples? You mentioned the Middle Ages. So for instance, you write that
the case I was describing was one where it wasn't private money, it was competing public monies. That is to say, and of course you have some element of that today, that one of the many reasons the US government doesn't want to have a really big inflation is that foreigners might stop using dollars. And since foreigners using dollars gives us an interest-free loan, we'd rather have them stop doing that. And it also gives us some status, just as the Byzantines got some status from the fact that the numisma was the sort of a world currency at the time. But I'm just thinking about whether, because most of the medieval currencies, and before that I'm familiar with, were state currencies, but they were state silver or gold currencies. And the problem was that they got debased. One of the problems, I should say, with before you have sort of modern systems, one of the problems you face, this is again from Carlo Cipolla, what he called the big problem of the small coins. And that is, if the value of the coin is really the amount of metal in it, if a gold coin, if the smallest coin you can handle is worth $1, then $100 bill you can handle, $1,000 bills can be pretty heavy, going the other way. So what you sometimes have is a gold big money and a silver small money. So in the Islamic sense, the gold dinar and the silver dirham. And then the problem is that you'd like to maintain a constant exchange rate between them. It makes it certainly easier for people to do business if they know that there are 10 dirham to the dinar or whatever. But you can't do that if they are both different metals, because the exchange value between the two metals is going to change. And one solution to that is that you make one of them the technical term is that basically a coin whose value exists only because it's exchangeable for the other. So that you say, we will issue dirham, we will guarantee if you bring us 10 dirham, we'll give you a dinar. And if you bring us a dinar, we'll give you 10 dirham. And that way, the supply of dirham expands or contracts however amount is necessary to keep the exchange rate at 10 to 1. The problem with that is that if in fact the silver in a dirham is only worth 1/20 of a dinar, then it will pay people to buy silver and mint dirham, take it to us, get a dinar for it, trade that for silver to make 20 dirham and go on forever. So in order to maintain that, you really need to have a way of preventing counterfeiting. And that was sort of the solution to that problem, is that one of your monies is a real money. The other is like our paper dollars. It's money that's worth something only because somebody, which could be a private issuer, says so, but that only works to keep other people from issuing it.
Are there any examples that you've seen since you've written this paper that piqued your curiosity other than Bitcoin and cryptocurrencies?
Not really. I haven't, I wrote it a long time ago and I'm interested in a lot of other things. So
what are you interested in?
Well, my most recent nonfiction book is something called Legal Systems Very Different from Ours, in which it came out of the fact that a long time ago, I got interested in the legal system of Saga period Iceland about 1,000 years ago, because there was a controversy between a couple of prominent law and econ people at University of Chicago Law School and a couple of prominent economists at University of Chicago Economics Department over the idea of essentially replacing our criminal law enforcement system with what you could think of as either a bounty system or something like a tort system. That the argument was, the way I put the argument, this is by Becker and Stigler, is that I'm a cop, you're a criminal, and I got the goods on you. I've got the evidence that'll send you to jail. And from your standpoint, going to jail is the equivalent to a $100,000 fine. And from my standpoint, getting you sent to jail will be a gold star on my report card. And it'll raise my lifetime income by $10,000 because I'll be a slightly better cop. Well, we know from Dragnet what happens. I take the evidence to the prosecutor, you go to jail. We know from economics what happens. Markets exist to move assets to their highest valued use. And the evidence to get you convicted is worth $10,000 to me and $100,000 to you. So you buy it from me for $50,000. Doesn't work very well. So the system is not incentive compatible. And that means that to make the system work, you need a second level of cops over the first level, watching the first level to make sure they don't take bribes, sometimes successfully and unsuccessfully. And then you got somebody watching the second layer and so forth. And so what Becker and Stigler said was, how about instead, we don't pay the cop a salary. When I turn you in for a $100,000 punishment, I get the $100,000. It's easy as if you imagine it's just a fine, but you could do it with a jail sentence, and then the government pays me instead of a salary an amount of money corresponding to that jail sentence. And Landis and Posner, who were two prominent people at the law school, pointed out, among other things, that they were really reinventing the tort system, because in tort law, the victim of a tort, sue you, and when you are convicted, I get the money. And more complicated, but sort of, so I got interested in that. And it turned out that there was a real world system I had come across in which if you killed somebody's relatives sued you. And that was Saga period Iceland. It was a society where there was a system of courts, there was a legislature and a system of laws, but there was no law enforcement, or at least no state law enforcement. It was all private. So I got interested in that and wrote what I thought was quite an interesting article that people still read about how that system worked, and learned a bunch of interesting stuff. And then I was lazy for a long time. And then I got interested in the legal system of England in the 18th century. And I originally got interested in that for what turned out to be an irrelevant reason. And the reason is that Becker had an old article in which he had argued that it looked as though, suppose the punishment for some crime is that we catch half the criminals and we fine them $1,000. Well, Becker said, we could get just as much deterrence if we caught a quarter of the criminals and fined them $2,000, or an eighth and fined them $4,000. Well, doesn't that imply that the ideal system has an infinite punishment or an infinitesimal probability? You keep on making it less likely and higher. And he had an answer that I think was the wrong answer in my view to why that wasn't the case. But it occurred to me that there was a legal system I'd heard about that looked as though it did that. Because the 18th century criminal law system was what was referred to as the bloody code, because essentially all serious offenses were capital. So I got interested in that. Now, it turned out it wasn't true that all serious offenses were capital on paper. But if you looked at what really happened, it turned out that if you were charged with one of those capital offenses, your chance of actually hanging was about 1 in 8. And if you were convicted, your chance was maybe 40%. So that in fact, on paper, it was all capital, but actually other things happened. So I got intrigued in how that system worked. But it turned out that what was interesting about the system was a system of privately enforced criminal law, because England did not have police until the 19th century. And that what happened in that system was that if somebody stole your horse, it was up to you to find the guy who stole the horse, to bring the evidence to court, to get him convicted. And unlike a tort case, you didn't collect any money. So why did anybody bother? So that was an interesting puzzle. And so I ended up writing what I thought was a very interesting article trying to make sense of that system. And then I was lazy again for a long time. And then it occurred to me that both of these articles had really been fun, and I'd learned a lot of neat stuff from them. So I ought to do more of that. And then the problem is, how do I commit myself to do work? So the answer is that I announced that I was teaching a seminar the next year in the law school on legal systems very different from ours. I had 2 already, and now I had to research a bunch more. So I taught that seminar every other year for, I don't know, 10 or 12 years, and then used the material I'd put together for that to turn into a book. And that was fun. So that's my most recent published work. What I'm doing at the moment is I decided I wanted to write something else, and I didn't have any brilliant new ideas. But it occurred to me that I had been running a blog called Ideas for about 15 years. And it was full of ideas that I'd come up sort of one at a time, anytime I wanted to say something about it. So I took 15 years of blog posts, which was a lot of blog posts, I can tell you, sorted them by topic, and I'm now in the process, have been for the last year or so, in the process of going through them, taking for each topic, trying to find a cluster of related posts, turning them into a chapter. And if people are curious, if you go to my webpage, I've got a link there to the drafts of that. I've so far done libertarianism, religion, education, and I've just put up economics. Although the last 2 chapters on economics, I think I haven't put up yet. But I'm going to do more as it goes on. So that's what I'm actually my current project. I've published 3 novels, and I'm theoretically working on sequels to 2 of them, but actually nothing's been happening on that for a while. So I'm not sure I can really claim I'm working on it, aside from thinking about it when I try to go to sleep.
Just one last question here. I was reading an article I wrote back in 2009, and I was thinking, man, I was pretty smart back then. I'm not sure if I'm as smart nowadays. Were there any blog posts that you read where you were impressed with your work or your thesis?
No, there were some neat ideas, but some of them I've improved. That what I was just doing yesterday and will be doing today was that I had a chapter which was basically on the evidence that that economics is wrong to treat people as rational. There's this very interesting book by a guy called Kahneman, who was a psychologist who won a Nobel Prize in economics, and who probably deserved it. And he had basically a theory of deviations from economically rational behavior. The book is called Thinking Fast and Slow. It's a really fun book. And I had discussed that in the chapter. And I suspected that I had misrepresented one of his arguments, that I was doing it sort of by memory, and I went back and reread it. And I had oversimplified it, so I corrected that. But it then occurred to me that there were actually 2 different interesting other ways of reading his evidence from his theory. So I added both of those, and when I finish this in a little bit, I will go back and expand on one of them. That both of them involved behavior under uncertainty, gambles people take, which doesn't seem to fit the standard model of rational choice under uncertainty. And Kahneman describes how people act, but I think there are a couple of ways of thinking about what he's describing in which it really is still rational. It's just rational in a more complicated picture. And it often is not worth including complications, because if you include too many complications, your theory becomes complicated enough that you can prove anything and learn nothing, essentially. So that was sort of interesting. And that was the case where I think I got farther this time than I did then. And there's another one actually where I had something where I had a really brilliant idea, which I then concluded couldn't be true. And going over it again, I decided that maybe it could be true, that maybe my counterproof was that I'd missed something in my counterproof. So there are a couple of ways in which I've not just repeated what I did before. But on the other hand, if I go over things like my first book, I think the really major ideas I've had have been a fairly small number, and none of them in the last decade. So in that sense, it's slowed down.
Any other comments before we wrap up?
No, thanks. People can see lots and lots of my stuff on my webpage. I've got the full text of a number of my books there, and most of my articles, both popular and academic, that people can read for free. The web is a so-so technology for selling information, but a wonderful technology for giving information away. So you just have to find ways in which you can achieve your objectives by giving information away, which is what I do.
When I watch the best salespeople, they're just constantly selling every 10 to 15 minutes, and it's probably because it works. We've had the honor of sitting down today with Dr. David D. Friedman. He's a legal scholar, an economist, a physicist, and a philosopher. He's got a large body of work that's available on his website at daviddfriedman.com. And thank you so much, Dr. Friedman, for sitting down with us today.
Thank you. It was fun.
Thank you, everyone, for listening. What's up, everyone? I hope you enjoyed the show. Head on over to GoldSilverBitcoin.com for more content like this, as well as long-form written articles about precious metals, Bitcoin, and other topics. Also, check out our shop where you can get precious metals, storable foods, and all sorts of other cool survival and prep gear as well.